Welcome to Telltales. I'm Mike Nicoletti. Every week, along with my co-hosts Jason Wallace and Hunt Lawrence, we bring you the Cash Flow Memo. Get it at telltales.us. For the next 30 minutes, we're going to dive deep into energy, technology, and healthcare. So download the memo now and get started.
The following conversation is intended for informational purposes only. You should always do your own work to determine if an investment is suitable for you.
Let's start. Nothing changes on Iran. I think I've been consistent since the event started in late February. On Exhibit C, I've made an attempt to have a decline in crude supply. It's not that much, actually. It's only 2.5 million barrels. And a decline in crude demand, which is about 1.1 million barrels. So an inventory draw of just under 2 million barrels. I mean, 2 million barrels a day is a lot. I mean, that's 700 million barrels a year. Just for example, on the bottom of Exhibit C are the May inventory numbers. In the United States, in commercial inventory, we maintain at any particular time about 1 billion barrels. You can see about half of that is crude, and then the rest is gasoline and blend components and Kero-Jet. I would think we use, as you see up top, the middle, we use about 20 million barrels a day in the US. So 1 billion barrels is about 50 days of consumption. I suspect that when I mount the June numbers, that billion barrels will have declined by, 50 million barrels or something like that. But there is a point at which you can't reduce inventories anymore because some amount of this inventory is in process. So a key question is, in the world, the chairman of Chevron, Mike Wirth, has said in the past several days that he believes sometime in July or August, on a worldwide basis, especially Asia, there'll be a kind of a red line that will be inventory shouldn't be lower than that red line. I think he's leaving out China, but I think he's talking about the rest of Asia, India, Pakistan, Vietnam, Thailand. He's running our second largest oil company. He probably has all kinds of information at his disposal. I have a different view. I hope I'm right, he's wrong. I think that the industry has been resilient enough to figure out how to keep inventories in those Asian markets, and for that matter, in European markets. And the adjustments are being made. The 20 million barrels, or 20% of global production, which is going through the Straits of Hormuz, I think are more than half made up by Saudi oil going to the Red Sea, Iraqi and Kuwaiti oil going out through Turkey, being trucked to Syrian ports, Abu Dhabi oil being routed down to Fallujah, which is a port outside the Straits of Hormuz. I think at these higher prices, there's some deterioration in demand. As we went into this, we probably had kind of a worldwide oversupply of a couple million barrels, 2.5 million barrels, something like that. So I think we're going to come through this all right. If we turn to the bottom of Exhibit B, we have the prices as of last Thursday. How that near-month price is depends on how the peace reports are going. Last Thursday, I think there was more possibility before the weekend or over the weekend that both Iran and the U.S. would sign an extension of the ceasefire, which would possibly get more traffic moving through the Straits of Hormuz. So the near month was 90. The 27 price, the futures price, had come down a couple bucks to 74. The 26 price, which at 82 had come down a couple of bucks. Those are the prices realized through May. And then the the forecast, the script for the rest of the year. I think when we look at it tomorrow, the near month will be up. It'll be more like 95. The 26 average price will be more like 84. The future strip will be more like 76. The forecast by some that, if this doesn't get settled somehow, the near month will go much higher, like 120, 140, those kinds of numbers. I expect and I hope that those aren't where we're going to be. If this impasse continues between Iran and the US, which I think is, if you're establishing odds, I think that impasse continuing for kind of indefinitely from a capital markets point of view, I would say indefinitely would be that when we're having these Wednesday meetings next May, June, things won't have changed all that much. I think that's at least a 50% probability. I think the Revolutionary Guards are ascendant in Iran. Ayatollah's son, he was appointed effectively by the guards. He doesn't make public appearances. I think his father was in a position where he could tell the guards what policies they had to honor. I think now the guards are the final arbiters in Iran. Interestingly enough, there's kind of a right-wing party in their parliament that is more right of center, I guess you'd say, than the guards are. The person who's a parliamentary speaker is part of the guards group. These more conservative, I guess you'd say more rigorous adherents to, battling against Israel and battling against the US had a vote to try to move the speaker. They lost the vote they got like 20 votes and the speaker got like 180. So you could argue that the control of Iran is now in the hands of these gentlemen who are 60 years old approximately. They're veterans of the 6-year war with Iraq. They're close. They have their own army. They have their own navy, that Mosquito fleet. Those are the guards. I believe they're in control of the missile inventory. I think they're in control of the drone inventory. There is an Iranian military, but it is, I don't know what its headcount is, but it is not where the military power in Iran is. The military and political party is with the guards. So I wish there were a better answer than we just kind of keep on. I think $90 oil is kind of $4.50, $5 gasoline. That's imposing a burden on people who use gasoline. On a worldwide basis or US basis, from a capital markets point of view, does that mean that high oil prices or inflation or inability to get interest rates down is going to cause a recession? Once again, I don't think so. Our economy seems pretty strong. The first quarter earnings season was terrific. Obviously, the economy is getting a huge boost from all the spending on artificial intelligence. The spending, Google, who hasn't issued equity since it came public, issued $80 million of equity this week. Amazon, Microsoft, Google, Meta, their capital spending is continuing to increase. The total amount of spending, we're in a $32 trillion economy in GMP. Their capital spending is $1 trillion. That's a huge impact on our economy. But the other companies that are reporting are all asked to comment on AI. They all say it will help them reduce costs. I think the economy actually looks pretty good. We're going to talk about healthcare. And to lead into healthcare, I want to talk about Exhibit A, which is a cash flow statement for the US government. We have a problem. Our economy may be great. We may be able to get through this period of higher oil prices, but we have to get the deficit down. Made an attempt last week to do a 27 forecast. This would be for the year that begins next October. Our fiscal year is, September 30 fiscal year. There is flat spending here for Medicare and Medicaid. Without that flat spending, with increased defense spending, which I think we can pretty much predict, not $1.5 trillion, which is what the Trump administration does, but a kind of a move from $1 trillion up to $1.2 trillion. With all other spending held flat, we absolutely, to make progress on our deficit, we absolutely have to hold the federal spending for healthcare, which is Medicare and Medicaid, we have to hold it flat. And that's basically what we're going to talk about this afternoon. And with that, Mike and Jason have been preparing for a couple of weeks for this. I think they're going to have a really worthwhile commentary here. And I've taken up more than 10 minutes. So you're not going to hear from me till the end of the call. Over to Mike and Jason on healthcare.
Okay, we've got a lot to cover here, so let's get going. The first point I want to make is that a lot of the rhetoric around healthcare becomes very partisan because it all points back to the Affordable Care Act. But the first story that I want to tell actually predates the Affordable Care Act, so you can take your partisan views and throw them out, at least for this part. And that's the case of McAllen, Texas versus El Paso. These are two border towns in Texas. And back in 2006, they pulled a bunch of data and concluded that even though the populations were structurally very similar, one of those cities, McAllen, was spending $15,000 per Medicare enrollee and getting worse outcomes, where El Paso was only spending $7,500 per enrollee, and their outcomes were significantly better on almost every vector. So the question is why? And this was, the important part is this was surfaced prior to the Affordable Care Act even coming into place. They have two different compensation structures at those two hospitals or those two cities for the Medicare services provided. One of those was fee for service, where the incentive for the physician is basically to increase the service so they can generate more fees. The other is, I guess you would call salary capitation, where essentially the salaries paid to everybody within the hospital system are not based directly on the services that they provide. And so the point is that in healthcare, there are these perverse incentives. And in this case, it's not that the doctors in one town are evil and the other ones are good. It's that when a system has structural incentives, they will gravitate towards what those structural incentives are set up to produce. So we knew this before the Affordable Care Act was implemented. So what happened with the Affordable Care Act? Very positive thing that a lot of people that didn't have health insurance all of a sudden had the ability to get health insurance. It's an important step forward for the country. What the effect on the business side, however, was very different. And what essentially was created is the greatest insurance business that's ever existed. And that is one in which zero risk is taken. For the insurers, they get a guaranteed profit, a 15 to 20% profit on top of cost of service. And as a result, the payer, the insurance company, is not incentivized to pay less for service. It's quite the opposite. They're actually incentivized to pay more for service because 15% of $100 is only $15, but 15% of $200 is $30. So the incentive structure was wrong from the get-go. Again, this is nothing to say that's negative about the idea that everybody should get health insurance, but the point is the business doesn't make any sense at all. So, okay, what's wrong with the system today? You have this no-cost payer, a no-cost conscious payer. We should talk about foreclosing of competition because that also occurred with the Affordable Care Act. Section 6001 was lobbied by the Federation of American Hospitals, and it basically foreclosed this idea of having physician-owned hospitals, which were lower cost, often more hospitals that would compete against the larger hospitals. We have not opened new hospitals since 2010 to compete with the main ones. And it actually gets even worse in New England. I think, Jason, gave me a stat on that earlier.
Yeah, there's con laws, so sort of need, where if you'd like to open a competitive hospital in an area, you have to prove there's a need. And to prove there's a need, you have to go to the existing players in the area and have them approve the need for a new hospital. So you have to ask your competition if you're needed, if you're allowed to compete there. And the answer is always no. And if there actually is a need, the only new hospitals are stood up by the existing players.
Yeah. So basically forecloses competition in the hospital system, and as such gives them more ability to raise prices. I think we should switch over to Montana, talk about Montana. So in Montana, this woman, Bartlett, she was in charge of the state employee healthcare. They were facing severe budget constraints. And in order to solve that, being the payer, she decided that she would get the prices of they were getting charged for some of the stuff. And one of the examples is a knee replacement, and she got it quoted at 2 different hospitals. That knee replacement surgery billed for $23,000 at one hospital and $103,000 at another in the same region. So what she did is she set a reference-based pricing structure at 2 times what Medicare paid and threatened to exclude any hospital that wouldn't take it. And there were some bumps along the way, but the result was dramatic. They saved a ton of money. They did not have to cut benefits. And eventually, all of the hospitals fell in line. So what this demonstrates is that if a cost-conscious player is involved, they can actually force the providers to compete. Now, unfortunately, Bartlett retired in 2019. And by 2022, the model was softened, hospital lobbying, and various forces that are endemic to the healthcare system have caused it to reverse back to its prior norm. And I think that goes back to it. You can have these one handful of standout people that do these amazing things out of principle, but in general, the whole system is going to follow the incentive structure. So Montana, gives us a point that it is possible for a cost-conscious payer to negotiate. It's just not what a lot of people are going to do.
Not what any of them do.
Right.
Yeah.
Right. Okay. Should we move to price transparency?
Sure. Price transparency is even if there was an incentive to price shop, it's structurally not possible. You'll never get a quote from a hospital or a clinic on what your care is going to cost. Even though this has been enacted, I think what was the year that it was 2021 that this was put in place?
It was, yeah.
Yeah, and the Trump administration the first time and the Biden administration neither chose to enforce this, and they're just now this year discussing enforcing this, but I don't think there's any teeth behind it as of yet. It's interesting that health insurance kind of has a design flaw where you alluded to it, that there's a set price that will be reimbursed, and most other forms of insurance do that. They take a regional average and determine what your house was worth or your car was worth in a loss event, but that does not happen in the healthcare industry. And you're penalized for going out of network. So they set these narrow lanes where you have to shop for your care or receive your care. You can't shop for it, and you're penalized for using other providers. So all that to say is the incentives were set up structurally that it eliminates competition. And it was well-intentioned in the ACA for the subsidies, and you have to subsidize low-income health insurance, even if it wasn't as expensive as it is. But when you look at the reality of those subsidies, they largely flow directly to the payers, to the insurers. And they're so vertically integrated today that they set the price, they accept the payments, and they provide the care. They're every facet of the healthcare system. And I think that's just a big problem that it's monopolistic. If it would happen in another industry, we would make a change.
Right. And there is a DOJ probe on some of their acquisitions. These happen from time to time. But if you look at this whole industry from the outside in, you're like, how is this not the largest antitrust case of all time?
Right. I guess another interesting case is there's a couple clinics, hospital networks, largely in Oklahoma and Texas, that have opted out of the system entirely. The most famous one maybe is, or most well known, is Surgery Center of Oklahoma. So this is what happens if you don't participate in the program the system we've set up, and it's a complete capitalist strategy, and they're a cash only system, all inclusive pricing, and they have a menu of prices essentially. So they don't participate with the insurance industry. And interesting enough, they don't participate in Medicare and Medicaid because some of the procedures that they offer, they can't offer at the price that Medicare wants to pay. Some of the procedures they offer, they want to sell for lower than Medicare wants to pay, but does not allow that due to some anti-discriminatory laws that are in place that you can't offer a cheaper price. So they're incentivized to not participate if they want to take this approach.
So how do you solve this problem? And
it's time for Hunt, who's been quiet here. we have about 8 or 9 minutes left, and I have a solution which Mike and Jason do not agree with and are going to cause all the problems. But let me lay it out. Now, as Mike covered, in Montana, the lady retired and the lobbyists took over, and pretty much the good work she done had been Republican Party, the Trump-led Republican Party, or the part of the Republican Party that Trump is leading, could in 2027, if he survives impeachment, join with the left side of the political spectrum. The leading figure there is Bernie Sanders, and propose a solution for this, which is anyone can come into Medicare at any age. That you, as one of our 320 million citizens, can be in the Medicare system, or you can opt to do healthcare. You're in the Medicare system, but you can opt to get other healthcare from another provider in addition to whatever Medicare provides. Would there be enough political support here? Because it would be bipartisan. It would be really, really fun to watch from a political point of view. Would the lobbyists be able to try to roll something like this back? Now, Mike and Jason, who are much more knowledgeable about healthcare than I am, are going to explain why that might not be a solution.
I'll let Mike go first because my answer might surprise you.
Oh, well,
Okay.
Mine might surprise you too, because I have three things that are necessary for us to start getting closer to a market-based system. One is the price transparency we discussed. 2 is you have to increase your low-cost supply. And 3, you have to have a cost-conscious payer. And your solution for Medicare for All falls under number 3 there, because even though the government is definitely going to run this more poorly than others, it is such a large entity. It's been able to negotiate what are undeniably very favorable rates for Medicare, right? So low that even the cash pay hospital wouldn't be willing to provide the service at that rate in a lot of cases. So I think that's one piece of the puzzle. So I think if you have that, plus you increase low-cost supply by reversing Section 6001 of the Affordable Care Act, that will encourage additional supply to come online and more efficient operators to participate. That would be helpful. And then if you actually enforce the price transparency, then the cost-conscious payers, which I think will expand beyond the government to the self-insured businesses, will have something to work with in order to do something here. And we'll let Jason take over and tell me why I'm wrong. And
No, so here, a few years ago, there was a new plan put into place called the Individual Coverage Health Reimbursement Arrangement, ICHRA. I only know of one company really running a platform to facilitate this. But essentially what it is that as an employer, you can grant your employees a budget that they then price shop their own insurance tailored to their own needs. And if they can if they're younger and they don't use much care and they want a high deductible plan, they can capture the savings. So at least in this instance, it puts the employee, the patient, as a price conscious shopper for the insurance side, and the employer is not forcing plans upon them that maybe don't make sense, or they were sold by a broker who does not have to disclose the fees that they get from the insurer for putting you in a high price plan. If a Medicare for All system was kind of like that, and you had a stipend that was able to be shopped, so there still is competition under the hood there, maybe that makes sense. And you don't have to fall into one of these Medicare Advantage plans. Maybe part of your plan is you're going to take coverage in your own hands and go to the cash pay hospitals. Something to think about. I think, again, like Mike said, that's one piece of the puzzle. And there's other things that need to happen. I think we absolutely need to break the vertical integration of the large payers that also own clinics and they own pharmacies and they.
Yeah, we could do a whole episode on UnitedHealthcare and how and why they've gone on the acquisition sprees that they have. Like, there's different layers to this that have happened over different various sets of years. And recently you've seen a huge wave in acquisitions of ambulatory centers and along the delivery chain.
Yeah. And we touched on mandating price transparency, allowing new supply to compete. I think we'll need to find a way to incentivize a shift to the reference pricing, as Montana did at the state level, and maybe Medicare for All could enforce that. It's clear as you said, Hunt, the lobbyists are. This is the biggest thing lobbied for.
Yeah, I think it's really similar if you think back to the original the antitrust cases back in the early 1900s on rail freight. It's so similar because of the rebate systems and all of that, except it's even more. At least some of the things they were doing there, you could justify because more cars had scale economies associated with it. So if you're a larger, shipper of coal or whatever, it would make sense for you to get more rebates.
Yeah.
In this case, it's hard to justify because you're talking about individuals.
Yeah. Mike found an interesting quote from the president of the AHA, and it's for all the good in the Affordable Care Act that it's clearly portions were written by the lobbyists, and the president there said that foreclosing on the regulatory capture of the hospital industry would not have happened without his lobbyists.
Yeah.
And because we haven't talked about AI in this episode, one of the great uses of it, well, first of all, one of the early uses of it was to game the medical coding system. So you upcode your procedures to get the maximum reimbursement from Medicare. But at the same time, we could implement real-time claims auditing. So if a claim is put in, you can process that, accept or deny it in near real time with some of these systems. It's just a modernization effort that needs to happen in training that system. Johns Hopkins did a study where they believe 21% of the care is medically unnecessary. And it goes back to, the case in Texas with the border towns. And they also estimate that 60% of care is shoppable, but nearly none of it is actually shopped. So we need to facilitate a system. Right now, the incentives are that the costs grow greater than inflation every year, which is unsustainable for the U.S. government. And we just need to align our incentives that that's no longer the case.
Now, I just want to come back to Exhibit A. If we have a debt crisis, if the overnight market for Treasury securities goes, rather than being on top of the Fed funds rate, the repo rate, rather than being on top of the Fed funds rate, it's up by a couple hundred basis points. And that happens. The Federal Reserve has to go to the rescue. We've now elected a Federal Reserve chairman who believes, has been outspoken on this subject, that the $31 trillion Treasury market, with the Fed owning about 6.5 or 7 trillion of the 31 trillion, is wrong. That the Fed should only own maybe $1 trillion or $1.5 trillion, whatever's needed to provide liquidity through the Fed funds market. So if we start taking that down. And you don't have to sell treasury bonds to do that. You just don't reinvest the proceeds as bonds mature. And if we continue to run $1.5 trillion deficit, and it could conceivably be more than that, you have to find a home for $2.5 trillion a year. Let's say $1 trillion resulting from the Fed balance sheet coming down and 1.5 for the deficit. It's not clear out there. There is $2.5 trillion of demand for U.S. sovereign debt. If in 2008, where we had the worst recession since the 30s because of the mortgage market, when our federal debt was much lower and the Fed could come to the rescue, what happened after 2008 was not inflation. What the average person, average investor says, oh, all governments inflate. That's how they handle their liabilities. But what happened after 2008 was deflation, not inflation. When what the Fed was worried about, and whoever was, Treasury Secretary, is a recurrence of the 30s, which was a deflation. So they kept pumping money into the economy, and that's how the Fed balance sheet got to 7 or 8 trillion. That is not sound policy. What has to happen is you have to get this deficit down so that the overall debt held by the public starts to come down as a percentage of GNP. There is no other solution that works without completely causing a huge problem in our capital markets and our economy. Now, if we go and we look at Medicare and Medicaid, that's, say, about $2 trillion. I believe overall healthcare spending is around 5.5. I believe the state contribution of Medicaid is about equal to the Fed. So that's another $600 billion. So of the 5.5 trillion we spend, about half is government financed. So and we spend about 18% of our GNP. No other developed economy spends more than about 12%. If we take 5% of our GNP, or $1.5 trillion, and half of it is saved by government programs, our deficit becomes quite manageable. It's really the only answer. So if we have a crisis like we had in 2008, where the Fed had to come to the rescue, it could be that crisis will result in Medicare for all. Now, Mike and Jason are going to comment on that, and then we're already 7 minutes over, and we can do some additional follow-up next week. And what I'm saying sounds like alarmist. It sounds like, not able to be supported. I believe in this logic, this economic logic, and how it would affect our capital markets and our economy. I believe in it down to my toes. It's just a question of when. But over to Mike and Jason to finish up today.
Well, to get it done before there's some sort of the house is on fire crisis would be an act of God, because like you said, it's going to require the left and the right to work together. So I hope that's not what it takes.
I don't know. No politician on either side will admit that their policies were ever wrong. They'll never go back and change course. So I think half the government's going to say the ACA was perfect the very first time.
We have to wait for all these people to die or get voted out.
Yeah.
Well, that's a lot of the problem. I mean, it goes back to lobbying, because it doesn't matter whether you're on the right or the left. You have the healthcare lobby has got you in their pocket.
All right.
That wasn't an upbeat answer.
It wasn't an upbeat finisher.
Please, for the people listening on the phone, or friends and family of people listening on the phone, don't go out and sell all your hard-won gains in the public equity markets. In all likelihood, companies with good cash flow and are going to be able to come through this. Look at it this way: Microsoft or Amazon or Exxon or Chevron or whatnot, those at the moment are much better credits than our U.S. government. You want to run your affairs so that you have ample exposure to U.S. equity markets, no matter what a house on fire situation might develop. And it's not impossible that Donald Trump and Bernie Sanders will come to the same conclusion, that this is what the two of them should push as their legacy. Remember, presidents or senior senators like Bernie Sanders start to run for the record books, not the next election. So I think there's some hope here. And we'll talk more about this next week, but in the meantime, we're way over. Everyone be well and stay healthy, and we'll be here in exactly 7 days. Take care. Thanks for listening. Bye-bye.
The views expressed on this podcast are the host alone and do not constitute an offer to sell or a recommendation to purchase or a solicitation of an offer to buy any security nor a recommendation for any investment product or service. While certain information contained herein has been obtained from sources believed to be reliable, neither the hosts nor any of their employers or their affiliates have independently verified this information, and its accuracy and completeness cannot be guaranteed. Accordingly, no representation or warranty, expressed or implied, is made as to, and no reliance should be placed on, the fairness, accuracy, timeliness, or completeness of this information. The hosts and all employers and their affiliated persons assume no liability for this information and no obligation to update the information or analysis contained herein in the future, and may or may not hold positions in the securities mentioned.